On a quiet Thursday evening in the spring of 2027, something strange happens across America. Not dramatic, not explosive, just strange. People insert their cards into ATMs and receive a message they have never seen before: transaction unavailable. Please contact your institution. Some try a different machine. Same message. Others open their mobile banking apps. Balances appear normal, but every withdrawal button is grayed out. Transfers say temporarily disabled. Wire requests say pending regulatory clearance. Within minutes, social media erupts. Within an hour, news stations report technical outages. Within a day, the Treasury Secretary steps in front of cameras and utters the phrase every American hoped they would never hear. Due to extraordinary financial instability and systemic liquidity concerns, we are activating the emergency banking protocol authorized under federal law. Behind those words is something far more devastating. Your money has just been legally frozen, not stolen, not seized, frozen the exact authority the government has quietly expanded for decades. This is not science fiction. This is not a conspiracy theory. This is not a prediction invented for entertainment. The United States government already has the legal power to suspend withdrawals, halt bank transfers, freeze brokerage accounts, delay settlement of trades, restrict access to retirement funds, and convert cash deposits into controlled digital credits. Most Americans don't know this. Most don't realize the laws have been passed. Most don't understand the precedent. But everything required for mass confiscation, not of gold, not of Bitcoin, but of your banked money, is already in place. And the mechanism is terrifyingly familiar. Most Americans have been taught that the government's 1933 gold confiscation was a bizarre one-time response to an extraordinary crisis, something so extreme that it could never happen again. They are wrong. What happened in 1933 wasn't an anomaly. It was part of a long, predictable pattern. When a financial system reaches breaking point, the U.S. government freezes money, controls liquidity, and restricts access to private assets. 1933 was dramatic because it involved physical gold, but the mechanism existed long before and has been used repeatedly. 1914, the first modern freeze. When World War I broke out, global banking panic spread instantly. Capital fled, gold drained, and the U.S. government moved swiftly. President Wilson invoked emergency authority to shut down the New York Stock Exchange for 4 full months. No trading, no withdrawals, no liquidity. The language used then, national security, financial stability. Extraordinary conditions is the same language used today. 1933, the Roosevelt shutdown. Most people only remember the gold confiscation, but the real weapon Roosevelt used came earlier, the bank holiday. Every bank in America was ordered closed for 8 days, withdrawals forbidden, safe deposit boxes sealed, cash rationed. When the banks reopened, depositors found their dollars had been devalued. Their gold was illegal to own, and the government now controlled the monetary system. 1971, the Nixon freeze. When Nixon ended the gold standard, he didn't simply close the gold window. He enacted a 90-day wage freeze, a freeze on prices, and temporary suspension of foreign exchange convertibility. Translation: the government froze the ability of your dollars to move change or escape. 2001 and 2008 digital era controls. After 9/11, the Patriot Act gave sweeping powers to freeze assets in the name of national security. After 2008, Dodd-Frank granted the government the authority to force bail-ins using depositor money to stabilize banks. The pattern is clear. Every time the system nears collapse, the government responds the same way it restricts your access to your money. And in the last 15 years, the laws enabling this have quietly expanded into something far more powerful than anything seen in 1914, 1933, or 1971. For most of American history, people believed something simple and comforting. The money sitting in their bank accounts belonged to them. It was theirs to withdraw, spend, save, or move whenever they wanted. But over the last 20 years, that belief has quietly become a myth. Without public debate, without major headlines, and without the understanding of the average citizen, the United States has constructed a legal and regulatory framework that gives the government the authority to freeze, redirect, convert, or seize liquidity across the entire financial system with a single declaration of emergency. The shift began after 9/11. Buried inside the Patriot Act was a provision that allowed the government to freeze assets without trial, without conviction, and without due process. It was marketed as a tool against terrorism, but the language was vague enough to include anything deemed a financial threat. That phrase, undefined, open-ended, and dangerously flexible, opened the first door. The second door opened in 2008. When the financial system nearly collapsed, lawmakers rushed through Dodd-Frank, a sprawling 2,300-page overhaul that fundamentally changed the rules of banking. Hidden within it was the concept of the bail-in. Instead of taxpayers rescuing banks, the banks could rescue themselves using depositor funds. The money in your checking and savings accounts was reclassified as an unsecured loan to the bank. In a crisis, that loan can be converted into bank equity frozen temporarily or locked behind resolution rules. You are no longer a customer, you are a creditor. Then came Title II, the Orderly Liquidation Authority. It empowered the Treasury and the FDIC to halt withdrawals, seize bank assets, and impose temporary access restrictions on deposits and brokerage funds if they believed such actions were necessary to prevent systemic collapse. Courts cannot intervene until long after the freeze has been executed. Finally, executive emergency powers were broadened to cover money markets, retirement accounts, brokerage platforms, and eventually digital assets. In the name of stability, the government can suspend redemptions, delay settlements, or block transfers across the entire financial network. Piece by piece, quietly and legally, the U.S. government built a modern system of financial control, one that no longer requires seizing gold or raiding vaults. Today, it can freeze your money with a keystroke. In the past, financial control had physical limits. If the government wanted to stop people from withdrawing money, it needed bank holidays, locked doors, armored trucks, and manpower. If it wanted to restrict capital flight, it had to shut airports, monitor suitcases, or regulate currency booths at borders. That era is gone. Today, the financial world is digital, instant, and fully traceable, and the U.S. government has spent the last decade building an infrastructure that gives it unprecedented control over every dollar you touch. It began quietly with FedNow, the Federal Reserve's real-time payment system launched in 2023. Marketed as a convenience upgrade, faster payments, instant settlement, smoother transfers, FedNow is in fact a centralized highway through which nearly all U.S. financial traffic will eventually flow. Unlike ACH or bank-to-bank transfers that rely on fragmented networks, FedNow gives the Federal Reserve direct oversight of transaction flows in real time. If regulators ever need to halt outgoing payments, freeze certain accounts, or block specific types of transactions, the architecture is already ready. Layered on top of FedNow is the early groundwork for a central bank digital currency, the digital dollar. Officially, the Federal Reserve claims it has made no decision on launching one. Unofficially, the technical infrastructure is nearly complete. Pilot programs with commercial banks, tokenized dollar prototypes, digital ledger settlement tests, and interoperability trials with FedNow all point toward one direction, a future where dollars can be switched on or off with software. In such a system, your bank balance is no longer cash. It becomes programmable credit controlled by policy rules, compliance filters, and emergency protocols. Every transaction leaves a permanent record. Every transfer can be traced, limited, or reversed. And in a financial crisis, a digital dollar allows something no government in history has ever had the power to do: instant nationwide freezing of liquidity without closing a single physical bank. The digital rails are already built. The only thing missing is the moment when the government decides to use them. Every financial control system, every emergency power, every liquidity authority, every digital infrastructure is useless without a trigger. Governments don't freeze assets in calm times. They freeze them when the walls are closing in. And in the United States, the walls are now closing faster than anyone in Washington wants to admit. By 2025, the U.S. national debt has blown past $37 trillion. Interest payments alone exceed $1.2 trillion per year, larger than the defense budget and larger than the budgets of Medicaid veterans programs or public education. The United States is now paying interest on its debt, with more debt a mathematical spiral that ends only one way. Foreign buyers, once the backbone of the Treasury market, have stepped back. China has been reducing its holdings for years. Japan, the largest foreign holder, faces its own crisis and must sell treasuries, not buy them. Oil-exporting nations now accept multiple currencies, weakening forced dollar demand. And domestic buyers, pension funds, banks, and mutual funds are reaching their limits. The Treasury still issues debt, but every new auction looks more strained. Bid coverage ratios shrink. Yields drift upward, forcing the government to pay more just to borrow the same amount. And the moment interest rates rise even slightly, the entire debt ladder wobbles. A 2 percentage point increase adds hundreds of billions in new interest costs. By late 2026, something breaks. A Treasury auction fails to attract enough buyers. A major bank reports an unexpected derivatives loss. A pension fund reveals a liquidity shortfall. A credit ratings agency downgrades U.S. long-term outlook. None of these events need to be catastrophic individually, but together they trigger panic. Markets freeze. Large investors rush into cash. Smaller investors withdraw savings. Money market funds face redemption spikes. Banks begin bleeding liquidity. And in a system built entirely on confidence, the moment confidence cracks, the system shudders. Then the Treasury invokes the phrase that turns theoretical power into reality: systemic liquidity emergency. Those three words activate the machinery built over 2 decades. Emergency asset controls, withdrawal limits, transfer restrictions, capital flight barriers, real-time account oversight. The government will not call it confiscation. They will call it stability. But the moment the declaration is made, the freeze begins. When the declaration finally comes, when the Treasury and Federal Reserve jointly announce a systemic liquidity emergency, the public won't understand what it means. At first, it will sound technical, abstract, another bureaucratic press release from officials in dark suits. But inside the financial system, everything changes within minutes. Banks don't wait. They can't. The moment the order is issued, the big institutions switch to crisis protocols. Withdrawal limits kick in automatically. Daily caps shrink from thousands to hundreds and then to zero. ATMs still show your balance because the balance still exists, but the withdraw cash button becomes a dead switch. It's there, but it doesn't do anything. Online banking portals update silently behind the scenes. ACH transfers are flagged as pending. Wire transfers flash temporarily unavailable. Brokerage accounts show perfectly fine portfolio values, but the sell or transfer funds options return a message most people have never seen in their lives. Settlement suspended. Due to market conditions. It doesn't matter which bank you use. It doesn't matter how much money you have. It doesn't matter whether you're a teacher, a surgeon, a CEO, or a billionaire. When the freeze hits, everyone becomes the same, a depositor waiting for permission. Money market funds halt redemptions, fully legal under the rules changed after the 2008 panic. Brokerage firms freeze pending trades to prevent destabilizing withdrawals. Retirement custodians quietly enable restrictions that allow them to suspend distributions during a liquidity event. The public reacts like they always do. Confusion first, panic second. Lines form at branches, even though withdrawals have already been disabled. People call customer service only to hear pre-recorded messages. Mobile apps show banners that read, "We are experiencing unusually high volumes." In reality, the system is not overwhelmed. It is deliberately paused. The government will call it a temporary measure. Banks will call it a necessary intervention. Journalists will call it a stabilization effort. But you will know exactly what it is, phase one of a controlled seizure. Once the freeze is in place and the public has been immobilized, unable to withdraw, unable to transfer, unable to escape, the government moves to the second stage. This is the stage that transforms a temporary liquidity emergency into a permanent restructuring of the monetary system. The announcement will sound reassuring at first. It always does. A government spokesperson appears on television with practiced calm to restore stability and protect the financial system. The United States will be introducing a temporary conversion mechanism for certain deposit categories. Most people won't understand the phrase. Those who do will feel the blood drain from their faces. The forced conversion begins with bank deposits, not all at once, not violently, not in a way that triggers riots. Just gradually, starting with the largest accounts. Balances over $250,000 are the first to be converted into digital federal credits issued by the Treasury. The government promises these credits are fully backed, secure, and necessary for stabilization. Banks immediately update your online dashboard. The money you once knew as dollars now carries a new label. It is still yours in theory, but it is no longer cash. It is a controlled instrument subject to policy rules. Then brokerage accounts follow. Money market funds convert into Treasury-backed stability tokens. Corporate cash accounts are migrated into restricted liquidity pools. Large institutional balances are reclassified as systemic reserves. And then comes the blow that mirrors 1933, the conversion ratio. For every $1 in your bank account, you receive $0.70 in digital federal credits, or $0.65, or whatever number the Treasury determines will fill the hole in the government balance sheet. They don't call it devaluation. They call it stability adjustment. They don't call it confiscation. They call it liquidity, harmonization, and crucially, they don't call it optional. Your balance changes automatically. No signature required. Your money simply becomes something new under a new name operating under new laws. Overnight, the dollar you knew dies quietly, replaced by a digital instrument that can be monitored, limited, reversed, or deleted. Just like gold in 1933, dollars are no longer real money. They are placeholders in a system undergoing emergency reconstruction. The government presents this as a rescue. But behind the curtain, the real purpose is simple: to erase trillions of government debt by reducing the value of every private dollar. And they are only getting started. Once deposits are frozen and converted, most Americans will assume the worst is over. They'll believe the crisis peaked during the bank freeze and that the digital federal credits are the final stage of the emergency response. They will be wrong. The largest pool of untouched money in America is not in banks. It is not in brokerage accounts, and it is not in corporate treasuries. It is in retirement funds, 401(k)s, IRAs, pension plans, annuities, and employer-sponsored retirement programs. trillions of dollars, the accumulated lifetime savings of nearly every middle-class American. And the Congress has had its eyes on this pool for years. For more than a decade, policy proposals have floated quietly through committees with almost no media attention. Terms like retirement stabilization accounts, patriotic bond allocation requirements, guaranteed income conversion options. Longevity. Insurance mandates sound harmless, even responsible. In reality, they are the groundwork for forced absorption. When the government announces the third phase, they will frame it as protection. The message will be polished and comforting. To safeguard American retirees during this unprecedented crisis, a portion of all retirement assets will be transitioned into newly issued long-term Treasury stability bonds. Behind the soft language is a harsh truth. Your retirement becomes a funding mechanism for the collapsing government. The process unfolds automatically. A percentage of your 401k is reallocated. IRAs are adjusted into compulsory bond purchases. Employer plans convert stock holdings into Treasury-linked instruments. Pension funds are ordered to increase their allocation to government debt. No vote, no opt-out, no appeal. Just like gold in 1933, just like deposits. In 2026, retirement assets become tools for national financial survival. The government takes what it needs and promises safety in return. But safety in a system that is already failing is an illusion. People think financial collapses happen suddenly, a single headline, a dramatic crash, a historic moment. But the most devastating resets don't arrive like explosions. They arrive like avalanches, slowly at first, then all at once. And the timeline for what's coming is already visible if you know where to look. 2025, the cracks become public. The Treasury quietly warns about structural deficits. Foreign demand for U.S. debt weakens. Bond yields drift higher. Money market funds begin tightening internal liquidity rules. Banks start restricting large transfers without explanation. The public barely notices. But analysts, real analysts, know the fuse has been lit. 2026, the first emergency directive. A Treasury auction fails, not catastrophically, but visibly. Bid-to-cover ratios fall to levels not seen since the 1970s. The Federal Reserve intervenes with temporary stabilization purchases. Financial media calls it a technical adjustment, but insiders panic. Banks start hoarding liquidity. Corporate treasurers move to cash. Retail depositors sense something is wrong. One regional bank falters. The government steps in. The phrase systemic risk appears in press releases for the first time. 2027, the freeze withdrawals slow. ATMs return error messages. Transfers stall. Then the official announcement hits systemic liquidity. Emergency declared. The freeze begins. Balance access is restricted. Money market redemptions are suspended. Brokerage settlements halted. Retirement plans locked. FedNow enforces real-time control. Digital oversight replaces free movement. 2028. The conversion digital federal credits replace old dollars. Retirement accounts are partially nationalized. Long-term Treasury stability bonds absorb private wealth. The dollar devalues silently. Inflation explodes as purchasing power collapses. Americans look back in confusion and disbelief, wondering how it happened. But the truth is simple. It didn't happen suddenly. It happened step by step, quietly, predictably, legally. And by the time the public understood what was coming, the system had already closed around them. When the dust settles, most Americans will try to make sense of what happened. They will ask why their dollars no longer buy what they used to. They will wonder how their bank balances transformed into digital credits without their consent. They will question why their retirement funds suddenly hold government bonds instead of the investments they chose. And their leaders will tell them the same story they told in 1933 and 1971 and 2008. We did what we had to do. Every monetary reset in history has been justified the same way, wrapped in the language of stability protection and national security. But the truth is far less noble. The resets aren't designed to save citizens. They are designed to save governments from the consequences of their own debt. The freeze was not the crisis. The conversion was not the crisis. The pension absorption was not the crisis. The real crisis was years earlier, hidden in the math no one in Washington wanted to confront. Debt growing faster than the economy, interest growing faster than revenue. A financial structure built on promises that could never be kept. And when a system like that reaches its limit, someone must pay. In 1933, it was gold holders. In 1971, it was anyone holding dollars abroad. In 2008, it was the middle class through inflation and asset manipulation. In 2027, it will be everyone with money in the system. But there is one final truth. Those who understand the pattern survive it. Those who prepare early keep their wealth. Those who wait for permission lose everything. A new monetary world is coming, one where dollars won't protect you, where accounts can be frozen instantly, and where the rules can change overnight. The question is not whether the reckoning arrives. It's whether you are one of the few standing when it does.